Well, good morning, everyone. Robert and Brian, thank you for joining us for our Founders Q&A session with Next founder Anthony Millin. We're excited to be offering these sessions on a monthly basis, last Friday of every month at 11 a.m. with Anthony, who is a serial entrepreneur, venture capital partner, startup attorney, and as I mentioned, the founder of Next, powered by Shulman Rogers. So without further ado, I will turn it over to Anthony. And guys, we have a small group today, so please feel free just to raise your hand or unmute and chime in with your question. You can also feel free to add them to the chat.
Well, it's great to be here with everybody today. And what we typically do with these sessions is we can kind of cover a broad range of topics in terms of whatever you have in mind right now. And so if anyone wants to start, we can jump right in.
Go ahead, Kobe.
Sure. So I just dive right in. I have a co-founder who is inactive, and I want to start thinking about what my options are. I've heard things like, offering a buyout, and the constitution of the board is two of us. So in terms of equity split, I assume it's 70-30 in my favor, and we're the two people on the board. Just really want to start thinking about what my options are.
So this is something that comes up fairly often with startup companies where something happens with one of the founders. One of the first questions I have is, when you set up your founder stock 70-30, did you set up any of the shares as vesting shares, or does everybody just own their shares outright already?
We're all vested. It was vested over 4 years. We've been working together for 7 years. So okay. Yeah, we're a good friend. Everything is, there's no negativity. It's just that he based on COVID, he's had to do sort of dial back and take care of parents and all that stuff.
So there are a couple of ways, The easiest way is, once you understand and work out what the ownership should become, is kind of the first thing. The second thing you can do is you can get a value on the share. If these are shares of common stock, you can get a 409A valuation on the common stock. Have you raised money?
No, we haven't.
So you can get a value. Shares can either be redeemed by the company, or they could be forfeited by the co-founder. And so part of it really comes down to the business deal that you want to put in place in terms of how much of the company should the co-founder be left with at the end of it, and how much are you, is the company in a position to buy out today? And then you can put a value on the shares through a 409A valuation. And again, you can have the company redeem shares, or you could have the person give shares back to the company at no price, or you can buy a certain number of shares. But there's a lot of options available if it's amicable. Where it becomes more challenging with vested shares in a 50-50 ownership structure and a 50-50 board is when you're not in agreement. And then it becomes more complex. You definitely want to find a law firm to work with to guide you through it and to paper it all correctly, and to just talk about the differences between those two different options. But the good news is you're friends, and hopefully there's a pathway to reach business terms, and then sit down with a lawyer to look at the most cost-effective and efficient way to achieve that result.
How would you rank from a tax perspective? Maybe sort of ranking them from a tax perspective first, and then from a legal complexity, transaction complexity. It sounds like the forfeiture would be the easiest, but I'm just curious based on tax and legal.
Yeah, you will take that, you will take them both into account. It's there. One of the questions is going to be the value that was paid on, if you're redeeming the shares and you're redeeming them at a higher price than they were purchased, then you are creating a taxable event. And even in the forfeiture, you have to kind of do a tax analysis, just because the other shareholder in essence is getting additional percentage ownership in the company. So I don't think either one, with two people and not a complex, are there other owners? So I don't think from a legal complexity, either one is overly complex. I think they're both manageable. And I think, you would want to just, as I said before, this is something you want to work through the redemption versus the forfeiture, and work through whether you're paying or not paying for those shares and how much you're paying or not paying for those shares. So the tax and the structure will come after you guys have figured out your business terms. Is this being bought out for nothing and it's just been forfeited? Is this being bought out for $500,000 or $1 million or 50,000? It's very much driven on what the business terms are going to be.
Thanks, Kobe. Great question. And of course, we're happy to follow up with you separately. Brian, I believe you had a question, and then we'll turn to Robert.
Yeah, so maybe continuing on the topic of valuation, that is very interesting for me. By way of background, I'm running a small startup fintech software. We have a user, we have revenue, we have some cash in the bank, so things are going well. One of our investors is actually interested in sort of investing more, and recognizing probably not the great time in the last couple of months, as the whole world seems to be falling apart. But obviously we would love to go down the path of a convertible note or a safe or something where you push that valuation out. But if they, we like them to be more engaged, but if they are really wanting to get to a valuation, we're just trying to wrap our arms around what the various sort of fair market value options you mentioned, 409A, which I conceptually know about, but where would you tell us to start? I know it's a hard thing to do, but what are ideas that you might have?
So the 409A is a different purpose to the valuation for purposes of bringing in investor capital. The 409A valuation is if you're issuing stock options or founder shares or buying up stock options or founder shares. It's a valuation that is kind of looking at the value of the shares of common stock based on a lot of today's factors. This is not an investor who's saying, what is this company going to be worth in 5 years or 10 years or 3 years? It's not, the 409A valuation and your cap in a convertible note or safe, or the price of the shares for preferred stock in a price round are two different values. And often the 409A valuation comes in significantly lower than the preferred stock price or the cap on shares that are going to convert to preferred stock, because preferred stock is going to have a liquidation preference over the common stockholders. They get their money back first in certain downside scenarios, or with something called participating preferred, they get their money back and then participate. So for the kind of valuation you're looking for to figure out what a cap should be on a convertible note or a safe, you're not usually going to use 409A.
Okay.
For purposes of figuring out what the right cap is, how much are you looking to raise, Brian?
A couple 100,000.
So I would do a safe. If you can do a safe, I would do a safe. If not, I would do a convertible note. I don't think you necessarily need to get into the complexity of a priced round, like a price preferred round. At that stage, we are seeing safes and convertible notes into the millions of dollars of raising. in terms of what the cap should be or the convertible note, have you raised before?
So this investor, we did make an investment, and they have a particular, I won't go into details, but a need to have a valuation. So on the first raise.
Yeah, you don't have to go into details, but there was a value put on the company.
Right. And we may have to do that again. So we might not have the option of doing a SAFE or convertible note. So that's kind of what I'm trying to get to. How do we best define what the value is at this next infusion or investment at that point?
Typically, what you would do is look at your last priced value.
Mm-hmm.
You would look at the milestones that you've achieved, the length of time it's been since the last round, what's happened in your own marketplace, if there've been any, how much more traction is there, how much have you reduced product market fit risk, have you added anybody to the executive team for execution risk, is the technology further along, reducing technology risk, all of those different things. If you can find, like on PitchBook, or somebody who can look up for you on PitchBook, similar fintech companies who have raised money and just seen what their rounds were, just to get some market comps of some companies. And after all of that, you're going to put a number out.
Right.
And then you're going to negotiate. Definitely, we're seeing investors negotiating a little more heavily on valuation.
Right.
And that you can't do anything about that, but we're still, it's not like we seen 2008 where Lehman crashed and the markets imploded and no one was raising capital. We still have a lot of people doing deals and raising capital for good companies that are showing progress. So I think the best thing to do is to just kind of look at those. If you have any advisors you're working with, it would be helpful to talk it through with them, either attorneys or other types of advisors that you work with, just to see what they're seeing. But typically, if we were working with somebody, what we would be doing now is looking at those factors, looking at what else we're seeing with other startups, and looking in PitchBook to see what comps we're seeing for companies that are doing those rounds. And then we would go back with a number. And if somebody's interested in your business and they feel like your number is high, they'll tell you.
Right. Great.
And that, they're not, you're not going to put out an outrageous number and say it's take it or leave it. You're going to just put out a number and then you'll start to negotiate.
Right. Wonderful. Thank you.
Thanks, Brian. Moving on to Robert's question, Anthony. Actually, it segues beautifully into sort of evaluations. And what are your thoughts on the current inflationary environment with valuations? What do you see on the horizon for the M&A environment for the next year? And then rounding out a comment about convertible notes in particular, how did they move from a bridge financing option to how much they're used today? So comments on current valuations, M&A environment in the next 12 months, and sort of thoughts on how convertible notes have become what they have become.
Yeah, I mean, we're definitely hearing anecdotally and seeing some examples where investors are pushing back on some of the really high valuations. I mean, but valuations have been, we were in an extremely high valuation marketplace that was very entrepreneur driven marketplace, meaning the leverage was highly on the side of the entrepreneurs. So I think that, like I said before, we're still doing, every week we're working with clients on financing. So this is not a situation where everything just has come to a screeching halt. I think that there are people who are going to look for more justification for valuations, meaning they may be still prepared to give fair valuations, but are going to want to see the basis for them. So if they're later stage investors, they're going to want to see more traction, more revenue, growth pathways to profitability, if not profitability. And early stage investors are going to want to see, some de-risking of the technology and some early product market fit with some at least initial signs of some growth or some traction. So everyone's looking for more to justify valuations, but I would not count on the same valuations that somebody maybe got a year ago. What was the question with the convertible? With, in the M&A environment, I'm doing much more of my time in the financing environment on the startup front side. We have a team that's an incredibly strong team that works with our clients on the M&A side. I know they're still working on deals. There's talk of that market slowing down a little bit. And valuations may be becoming a little, lowering, but there is a lot of capital in funds in the marketplace.
Hi, honey.
Hi, Mom. I'm good. I just got there.
Okay, great.
Sorry about that.
Okay. And then there was just a question on the convertible notes bridge, and I wasn't sure I followed exactly what that question was.
Robert, do you want to ask the question again? It was more about, I guess it sounds like convertible notes were originally just for bridge loans, and now they've become, something, well, for a long time, they've been used more readily. But Robert, was there a specific angle to, for pre-revenue? Oh, no, that was a different comment. Robert, did you want to clarify that question? Perhaps not. So I think it was just about, how convertible notes have become, what's the term of art?
Oh, I see. How I don't prefer most convertible notes. How do convertible notes move from a bridge financing option to how it is used today? So, it has become, along with safes, a go-to instrument that is used in early stage financings. And again, a lot of it is used not just as a bridge, but because it's so hard to value early stage value, when you've got on one side, you have the founder who sees all of the upside, all of the growth potential of the business and is looking at it from that perspective. And then you have the investor who's looking at the technology risk and the market risk and the capital risk, and they focused on that. And this is before maybe a product has been built, or before you have product market fit, or you have product market fit, but not a lot of growth yet. So it's just, you move to these instruments that allow the early investors to have a chance to deploy capital. And when the company was further along and you had the opportunity to price the company with more specific data, the early investors got the benefit initially of what used to just be a discount, but then what became a discount and a cap. And so it just became a less expensive instrument. So it's a lot less expensive and a lot less paper to do a convertible note than a priced equity round, usually because of all the rights and preferences in the priced equity round. And then it became even more cost effective and efficient to do a safe. And there were a number of benefits of the safe for at least from the entrepreneur's perspective and for many investors to doing the safe. And those just became the go-to instruments versus looking at any price rounds.
Any follow-on questions from anybody? We've got a few minutes left in today's session.
I have a question on licensing.
Okay.
We filed our provisional patents, and I am wondering whether, for sort of international markets where we might not be entering directly, in the next few years, whether it's possible to license provisional patented technology, whether it makes sense at all to even pursue. Seems like the upside is some early revenue, but also seems like there could be quite a bit of downside.
Yeah, in terms of the strategic value of, do you want to be you asking whether you should be getting protection internationally for your technology, or whether you're licensing your technology internationally without protection?
What I mean is, we don't have the full patent yet. We just have the provisional. And I'm wondering whether it makes sense to pursue licensing as part of our go-to-market.
So what I would recommend on that is speaking to a patent attorney to first understand what your rights are in terms of licensing something that hasn't been approved yet. Right, at this point in time, you have a provisional patent that's been filed, but you haven't received approval or filed your formal patent application. So the first thing I would want to do as an entrepreneur is to first understand the extent to which I can license. What is it that I would be granting the license to? And what is it that the licensee is going to expect if they're paying for that license, or that license is generating revenue, that they're going to expect or have me rep that I own in that grant of that license. So I do think it's worth it shouldn't be a very long call, but I do think it's worth having a brief call with a patent attorney, or go back to the firm that did your provisional patent for you, and ask them, what your licensing rights and opportunities are off of just the provisional, or if you have to wait to file, or if you have to wait to be granted.
Okay. Thanks.
We got about 3 minutes left. If anybody has a comment or follow-up question. Your thoughts, Robert's chiming in, your thoughts on the debt option capital raise in the inflation period.
The instruments that in terms of capital raising, we're seeing a lot of companies who are unsure where the market is going and if the market is going to deteriorate, to use this time period to do a top up or an initial capital raise. So people who weren't sure if they were going to raise now, or maybe they were going to wait 6 or 12 months, are looking at, should they jump into the market if they're able to, and just give themselves some extra runway till they understand how things are going to be unfolding globally. In terms of a safe financing, if you're raising on a safe, there is no interest rate, so you're not impacted by that. In terms of a convertible note, we're seeing a lot of convertible notes, even though they have an interest rate. No one was really investing in convertible notes to be a big interest rate wasn't a big term in the convertible note. And so people weren't looking for very high interest rates, or looking for those, there are a lot of other investments with higher returns if you're only looking for interest and not capital appreciation, than doing a convertible note in a startup company. So I feel that you may have some rise in the interest rates that are showing up in convertible notes, but I don't expect it to be substantial because that's not the driver for most people who are doing convertible note investments.
Right. Well, we're almost coming to an end. We'll let you go with 1 minute left. I hope everybody has a wonderful holiday weekend. Thank you so much for joining our founder session today. Put in the chat the link for our events page to see what is going on with Next. We always have great events coming up, including next week on June 8th, our partner webinar on financial modeling and fundraising, brought to you by Early Growth. And the best way to stay in touch with us is to sign up for our alert, which can be done on our website, next.law, sorry. And then, of course, follow us on LinkedIn. So thanks to Anthony for taking the time, and thank all 4 of you for joining us today. Have a great holiday.
Thank you very much.
Great,
Thank you.
thank you.
Thank you.
Bye-bye.
Bye.